AeroVironment closed fiscal year 2026 with a headline loss of $265 million in revenue that nearly tripled, and almost none of that tells you what actually happened to the business. This is a year where the GAAP report and the underlying story are two almost separate documents, separated by an acquisition that roughly doubled the company overnight. In this video, we'll break down what the numbers actually mean, where the cash went, and what the fiscal 2027 setup looks like. Let's get into it. AeroVironment is a defense technology company built around unmanned aircraft and autonomous weapon systems. Its legacy business, Switchblade loitering munitions, Raven reconnaissance drones, small tactical UAS, sits in the autonomous systems segment, which generated about 3/4 of fourth-quarter revenue. The second segment, space cyber and directed energy, is the BlueHalo portfolio, counter-drone systems, directed energy weapons including Locust, laser communications, and space applications. The customer base is almost entirely the U.S. military and its allies. Fiscal 2026 is the first complete year with both businesses fully consolidated. Before we read a single number in this report, we need to understand the lens. AeroVironment completed the BlueHalo acquisition at the very start of fiscal 2026, and BlueHalo contributed essentially nothing to the fiscal 2025 comparison period. That means every year-over-year headline, revenue up almost 141%, assets up over 400%, equity up nearly 400%, is an accounting artifact of consolidation, not performance. Management was clear about this on the earnings call. Organic revenue growth, stripping out the acquisition, was plus 30%. That is the number that reflects what the business actually did. Everything else is an inorganic reset. On an organic basis, the revenue trajectory is genuinely strong. Full-year revenue reached $1.98 billion with 30% organic growth. The fourth quarter set a company record at $641 million, 31% organic. Forward indicators are supportive. Total backlog stands at $2.7 billion, roughly 1.4 times full-year revenue, with a trailing 12-month book-to-bill of 1.4 times. There is one softness metric to flag. The fourth quarter book-to-bill came in at 0.9 times, below 1, meaning orders in that quarter didn't fully cover shipments. Management points to the trailing 12-month figure as more representative, but it's worth tracking. The profitability story runs on two parallel tracks. On GAAP, net loss of $265 million, operating loss of $311 million, diluted loss per share of $5.40. On adjusted, EBITDA of $286 million at a 14% margin, above management's own guidance, and non-GAAP earnings per share of $3.31, also above the guidance range. The spread between those two views is roughly $550 million, explained primarily by the $89 million goodwill impairment from SCAR termination, plus acquired intangible amortization and stock-based compensation. These are real economic events, but almost entirely non-cash. The cash flow statement provides a useful reality check. Full-year operating cash flow was negative $78 million, better than the GAAP net loss of negative $265 million by roughly $187 million. That gap reflects non-cash add-backs, primarily the $89 million impairment and BlueHalo intangible amortization. The underlying cash drain is real, but meaningfully more contained than the income statement suggests. The fourth quarter produced the first positive free cash flow since the first quarter of fiscal 2025, plus $73 million, a directional improvement. But the full year is still negative, and management guides free cash flow to remain negative in fiscal 2027. Gross margin is where the BlueHalo acquisition leaves the clearest structural mark. AeroVironment's fiscal 2025 GAAP gross margin was 38.8%, a product-dominated business with strong unit economics. In fiscal 2026, that fell to 25.3%, a compression of 13.5 points. The cause? BlueHalo's services revenue carries an adjusted gross margin of approximately 2% in the fourth quarter, against roughly 44% on the product side of autonomous systems. On an adjusted basis, stripping out acquired intangible amortization, the full-year blended gross margin was 30%, and the fourth quarter reached 34%. The direction is improving, but the services mix headwind is structural. The balance sheet grew dramatically. Total assets from $1.1 billion to $5.7 billion. Equity from $886 million to $4.4 billion. Both expansions trace to acquisition stock issuance rather than retained earnings. The GAAP net loss of $265 million actually worked against book value during the year. The enlarged asset base is dominated by goodwill and intangibles, and the $89 million impairment recognized in year one signals that not all of that acquired value is intact. Funded debt is $747.5 million in zero-coupon convertible notes, against $713 million in cash and investments. Net leverage of 1.2 times adjusted. EBITDA looks manageable, but with operating cash flow negative and fiscal 2027 free cash flow guided negative, the buffer is finite. The two segments tell different stories. Autonomous Systems generated $492 million in the fourth quarter, up 49% on a pro forma basis. Precision Strike alone hit $333 million, up 80%, driven by Switchblade, Red Dragon, and the Titan counter-UAS system. That is the demand franchise anchoring the growth thesis. The space, cyber, and directed energy segment is more mixed. Directed energy and space grew 23%, with Locust achieving a 100% maritime kill rate aboard a U.S. aircraft carrier, and a $240 million laser communications contract confirming demand breadth. But cyber contracted 26% following the SCAR termination, which removed a $1.5 billion backlog item from the company's books. The recovery trajectory heading into fiscal 2027 remains uncertain. Several flags in this report deserve direct attention. First, management identified a material weakness in internal controls during fiscal 2026. Remediation is underway but not complete. And for a company that just quintupled its asset base through an acquisition, that timing is particularly unfavorable. Second, the GAAP to non-GAAP earnings gap is $8.71 per share. Much of that traces to legitimate non-cash items, but a spread this large requires ongoing scrutiny, especially while controls are under remediation. Third, the SCAR termination produced a real $89 million write-down in year one, a concrete example of what program concentration risk looks like in a defense contract book. And fourth, operating cash flow was negative for the full year, and fiscal 2027 free cash flow is also guided negative. On insider activity, there is nothing to report. Zero open market buys and zero open market sells in the window covered. That is neutral, not bearish. Insiders are typically in blackout periods around a major filing like a 10K. On the events side, the company appointed William J. Lynn III to its board on June 25th. Lynn is a former United States Deputy Secretary of Defense, and his arrival reinforces AeroVironment's connectivity to the defense establishment at a time of expanding program scope. The most market-relevant event is the earnings print itself. The after-hours reaction of plus 19.3% signals that the street materially underestimated both fiscal 2026 execution and the fiscal 2027 guidance that accompanied it. Management guided fiscal 2027 revenue of $2.125 to $2.225 billion, roughly 10% growth at the midpoint, with adjusted EBITDA of $305 to $325 million. Four monitors will tell you whether that holds. First, SCDE stabilization. Cyber is down 26%. Can directed energy and space offset that hole? Second, free cash flow trajectory. The fourth quarter turned positive. Does that momentum sustain through a CapEx peak of 12 to 14% of revenue across 3 new manufacturing facilities? Third, material weakness remediation. Any auditor update on scope and timeline? Fourth, first-half bookings cadence. Management flagged a 45 to 55 first to second-half revenue split tied to continuing resolution budget dynamics. Early quarter data will confirm whether the DoD budget is normalizing. Here is the one-line summary. AeroVironment delivered 30% organic growth, beat adjusted earnings guidance, and closed the year with a $2.7 billion backlog, while also reporting a GAAP loss, negative operating cash flow, and a material weakness in internal controls. The underlying business has genuine momentum, but the integration work is not finished, the cash is not yet self-sustaining, and the reported financials require significant adjustment before they reflect recurring earnings power. Fiscal 2027 will be the year that shows whether BlueHalo was a transformational step change or a complication that takes longer to absorb than planned.